Let's talk more about the bull market, but is it actually a bull market yet?
I think it still qualifies as a long-term bull market. We might have had one of these bear market interruptions late last year.
A baby bear,
A baby bear. So the pattern here would be about a 20% loss in the S&P 500. That happens very quickly as part of a growth scare, but not a recession.
Why is it a baby bear?
Because it's brief. 20% barely just tagged it in December. And also because it's not associated with a recession. It's not one of these multi-year grinding losses like we had in the early 2000s and 28.
Is that, and Jeff, I'll ask you, is that because of the Fed? Neil Kashkari this morning basically said the pause last week is keeping GDP growth on track. And Steve Leisman referenced the same idea a couple of weeks back. He said that when we've had sell-offs like this and the Fed responds, you know, it helps prolong the rebound. Do you think that's what's going on here?
Well, I think that the policy issues are part of the equation that's given the market a lift. We've gotten good news on the Fed front and on the trade front, but quite frankly, it's just in the data. And we thought people were uber skeptical and pessimistic last year when, particularly late last year, when the data just didn't support it. And if you looked at manufacturing, service, employment, the data, by and large, was definitely tilted to the positive, and that's why we remained positive on the market.
Jeff, what do you think about this factory orders report? It was delayed. We only just got it because of the shutdown. This goes back to November. You know, it's not a huge input, but it's more of a barometer. And it says that we were so worried about the first quarter GDP. It turns out maybe the fourth quarter was only a little bit over 2%. I know that's so backward looking at this point. So what do you think the significance, if anything, is of this report today?
You know, it's just a mosaic, and we can, look at one number and have some kind of negative reaction. But when the preponderance of the data, and there's a lot of it, look at the ISM that came out last week, look at all-time lows in unemployment claims or lows going back to 1969. And, if you just look at the preponderance of the data that we see out there, no, I'm not worried about a factory orders report. All
right, and we'll circle back in just a minute to some of the stocks that you like here. But, Mike, I also wanted to call attention to the market conditions that Stifel highlights this morning. They say the rebound that we've seen since the Christmas Eve lows has more than 11% of the S&P now in overbought territory. That's the highest level since September 21, which was the day after the all-time high. So should we be worried that now we've come back too far too fast?
I think some of the short-term indicators are showing that we've used up a lot of that negative sentiment from December. This rebound rally has gone a little bit farther and a little bit longer than you typically see, and it basically hasn't obeyed a lot of these points where it would have been logical to pull back. Some people will say, well, that proves that December was this downside overshoot that we're just kind of making up. But yes, I think it makes sense to prepare for some kind of a pause or a reset or something like that, just because of short-term overbought conditions.
All right, so Jeff, give us some areas of the market, overbought or not, that you like here. I see financials as one of them, and I'm curious if you're worried about this. And also, Procter & Gamble, which you own, I guess, in the fund and personally, all-time high today, going back to 1896, I think, when it listed, and Boeing. So what about the financials?
So we do like the financials kind of just across the board, and they certainly haven't participated. But the cyclicals, which include the financials, yeah, we do like. So whether it's Bank of America, Schwab, or if it's in fintech like a WorldPay, we think that those stocks are attractively priced, and they've maintained pretty solid fundamentals throughout here. So it's about time that they participate in the upswing. We also like other cyclical areas of the market, like industrials, cyclical tech, consumer discretionary. Broadly, we've been positioned there when many folks were saying, hey, run to defense. And we just haven't thought that would be the profitable kind of scenario or case. And certainly this year, we're being rewarded for that.
Absolutely. And kudos to you on that. So tell me the case for Procter & Gamble then, which I don't think is the cyclical, unless I'm wrong.
Well, of course, I'm in Cincinnati, today. And so, hail from the city where they reside. 5 years plus of kind of underperformance where organic growth has been challenged. And finally, we're starting to see through some marketing initiatives, some innovation, you're starting to see that growth. They had a wonderful report, this last report, where you saw organic growth that was actually above expectations. So we think it's a pretty good time after underperforming for a while to own Procter & Gamble.
Mike, last word to you then. So we have maybe, we came back too quickly, maybe, if, based on some of this, but if we start to look at cyclicals outperforming and clear through earnings season and so forth, what do you think are sort of the parts of the market that could keep going?
I mean, the longer term implications of having this 20% reset, having people panic in a very short period of time in a concentrated liquidating of stocks way in December is that the most beaten up parts of the area should rebound first. We've seen the cyclicals, you saw the semiconductors and all that stuff. It's not clear to me, though, that if we actually stay in an uptrend, that people are going to totally ignore the big dominant growth stocks that kind of got us here. So I don't know that it has to necessarily be one sector, one type of market. The big question is the Fed correct to be patient? And are we back into a low growth but sustainable growth picture? And that's going to decide whether, in fact, all these people drawing comparisons to 2011 and 1998, where you had these very happy endings, whether that's going to bear out.